if you wanted an 8% return, you're looking for a purchase price of around, well, that's your purchase price. You're looking at a 1.25. Very simple math, we just did it backwards. 8% return of this. Remember, we do net numbers. So it doesn't matter what they throw at you, you care about what the net number is. Now the trick is figuring out how accurate that net number is. So the first thing you're gonna need from every single person you talk to is you gotta have their gross income. And that's everything. That's their, let's say it's an apartment building, you need to know their, not just their rents, you gotta know all their deposits, you gotta know all of their laundry mat fees, pet fees, everything you possibly can. You gotta figure out what the gross number is. And if that gross number is $200,000, it's gonna range, your expense ratio is gonna range from 40 to 60%. It's just the way it is. If it's a newer building, closer to 40%. Older buildings, maybe up north or something where the heating costs are outrageous, it's probably gonna be like 60%. Just kind of depends on where you are. Now, if it's a retail property, you're probably looking around 25%. It just also depends on the strip plaza, it depends on how big the structure is. If it is a Dollar General where you only have one tenant and they pay for everything, well, your expenses get a lot lower because you're still responsible for the parking lot, you're still responsible for maybe the roof if that's not in the agreement, and same thing with a warehouse. An office building is different. If we're in this office building and there's a light out over there, someone's gonna hear about it. They're gonna know, hey, we need to fix what's going on, who's in charge of the building. So just kind of depends on the property, but evaluating anything, you just wanna kind of work backwards on what you're looking for. So if you're to look at a listing and you see a 7 or an 8% return, maybe that's their cap rate, you need to take a step back and find out who the buyer is. So if you have a buyer and you're looking for something, first thing you want to start looking at is the gross. After your gross, just start using your expense ratios. And your expense ratios usually, on average, could be anywhere from 25, depending on the property type, of course, they go up to 50. But if you want to do, let's say, an apartment building, a quick evaluation, if somebody tells you they net that much, that's kind of where you're going to be. If it's going to be a retail building, anything like that. Now, what's happening, before I forget, 8% right now, well, a couple of years ago, 8% used to be pretty common, used to be pretty solid. 8% now is not the norm. You're seeing a lot less. And unfortunately, buyers are paying for it because there just isn't a lot else on the market. There isn't a lot else out there, and they can get financing for it relatively easily. The issue comes in if you have a property of this size and you're putting 25% down. Let's say you're putting $500,000-$600,000 down on the property. If it's still not cash flowing, the deal's not going to work. It doesn't matter. So they only can raise prices so much. That's kind of what I'm letting you know. It doesn't mean those things are wrong. Now, there's a lot of brokers out there. You guys probably have seen this. I don't want to name drop anybody, but you'll see a 46-page report. There's only 2 pages of financials, but the rest of the report is pretty pictures and all this great stuff. None of that stuff matters. Those are all just for marketing. You only need those 2 pages of telling you what this thing brings in, what it is at the end of the day. Everything else is useless. Toss all that stuff out.